It is happening again. Another record number of Cybertrucks has been spotted at Giga Texas. This was tonight, really. And many were spotted at the outbound car carrier lot. So these Cybertrucks are getting out of Giga Texas to their owners. I think soon we will see 200 Cybertrucks at Giga Texas. And there's a chance that Tesla could beat expectations when it comes to Cybertruck. I think right now most investors are not expecting almost anything from Tesla in terms of volume production. So if Tesla ramps production pretty well, the stock could rally as well. I'm not saying that it will definitely happen or even that it's very likely to happen, but I see so many people saying that, oh, there's no point in holding Tesla stock for another few years. But these people forget that generally the sentiment with Tesla historically has always been negative, and then suddenly something happens and then the stock just shoots up suddenly. And then we have another period of extreme negativity. And this is certainly good for Tesla's demand. Looks like Jay-Z and Beyonce have taken delivery of a Cybertruck. They wrapped it matte black. Elon says, nice. I think the wrap actually looks really good. I like this color quite a bit. There are some matte black colors that I look at and like, I don't know, but this one I really like. A new updated Tesla model has just been spotted for the first time. And this is specifically a refreshed Model 3 Performance. This is not a plaid. As someone says, it's a plaid, but it's not a plaid. If you look at the badge, it's not a plaid badge. Visually, I see some differences. The front splitter, I can see that. Aero cover wheels. I think these wheels look pretty good. The rear spoiler, red brake calipers, of course, which is very fitting for the performance version. Ludicrous badge, it's not a plaid badge. The car, I think, is also lower, and overall, the aesthetic looks really nice to me. I love it. We also know that it has performance seats. For those that want to argue that it is a plaid badge, no, it's definitely not. Look at the ludicrous badge right here, and this is a plaid badge. Clearly, this is a ludicrous badge on the new Model 3. Tesla Optimus bot engineer at Tesla had a few things to say about the new video that Tesla just released, showing the Optimus bot progress. This is our fastest gate ever at 0.6 meters per second, which is a 30% boost since Tesla's last video in December, which is really impressive. We have improved our vestibular system, or in simple terms, the balance system in the bot, our foot trajectory, and our ground contact logic. We have upgraded our motion planner and made cuts to the loop latency across the bot. Optimus is more stable and more confident overall, even during turns. We also added a slight torso and arm sway. If these challenges speak to you, join the Tesla AI team at tesla.com/AI. What other car companies are doing this? Anyway, the bot went from this to now walking fairly confidently. Now on the left, you can see that the bot had some extreme constipation issues. On the right, the issue is still present, but the issue is nowhere near as bad, because clearly you can see that the bot has lost some weight, which is a clear sign that the health of the bot has improved. There's some debate going on whether FSD12 on the highway is end-to-end or whether it's using the old highway stack from FSD11. Omar says many people insist FSD12 is the old highway stack. However, I have noticed some changes, some positive like lane changes, but also some regressions. I can see some indications of the visualization changing. I think it must be a mix of the old stack plus some end-to-end for things like lane changes, maybe, I don't know. Tesla Scope says, though, Tesla has made improvements to highway driving with the recent software updates, but it's still running the old stack, which is further why the release notes focus on city driving. We have spoken to and confirmed that end-to-end highway is being tested. To which Omar responded with, yeah, I have talked to him about this with Tesla Scope, I believe, but my gut still tells me it's not just V11. I am seeing different behaviors. Could just be the latest version of the old stack or maybe something else, but V11 cars I have drive differently on the highway. Merging onto an interstate seems to definitely be the old stack, meaning it's not end-to-end. Highway for people already worked really well, so maybe Tesla's philosophy is don't fix it unless it's broken and only do end-to-end for highway once the city end-to-end driving is incredibly good. AI Driver says FSD V12 completely fixes all my turn signal complaints. It's so good I forgot to even mention it in my initial review. I don't even think about it anymore. To me, it seems that Tesla is prioritizing city driving, which is more difficult to solve. So if you solve that, clearly you're going to solve highways. So I don't have any complaints with this Tesla strategy. Whoa, this is a bit high. BEV share in Norway reached a new high of 92% in January. You know it's coming to all other countries later on as well. Looks like someone took this Cybertruck to a work site. It's dirty. Here's where the dirt came from. Gary Blatt just shared some of his insights from his Tesla valuation model. Number one, we see 2030 EPS at $21 per share based on our long-held view that EV adoption will continue to surge to around 60% by 2030 and that Tesla can capture roughly 20% of that. Number two, that equates to about 10 million units by 2030 versus Wall Street's expectations of just 5.7 million units. We assume 35% of those 10 million units are from the new $25,000 to $30,000 next generation vehicles, which holds Tesla's average selling price at its current $45,500 per vehicle level. I expect Tesla's average selling price to be a little lower than that though. Number three, we assume auto gross margin stabilized at 17% in 2024 and increase to 22% by 2030. Other than volume, auto gross margin becomes the most important Tesla valuation driver. Number four, we assume a global FSD take rate of 12.5% on 45 million cumulative Tesla cars by 2030 at $199 per month. That represents $2 per share in our 2030 EPS. Number five, we assume Tesla regulatory credits, $1.7 billion in 2023, go to zero by 2027 as other manufacturers' EV businesses grow, although I'm not too sure about that because Mercedes just backtracked on their EV plans big time, and it appears that some other legacy automakers are going to follow that as well. We assume that 2030 energy business 10x's and 2030 service business 4x's from 2023. Very roughly, I think that's about 40% year-over-year growth, assuming he's talking about revenue. Number seven, we assume insignificant 2030 earnings from FSD licensing, Robotaxi, Dojo, or Optimus. It's a safe bet to make, but I think that bet is not going to be exactly right. There's going to be something that Tesla is going to do that will surprise investors by then. Number eight, the challenge is, what is the appropriate price to earnings to attach to Tesla in 2030 based on Tesla's future 2030 and further earnings growth rate? Here, with 2030 EV adoption projected to be at 60%, the forward growth trajectory is bound to be much slower. On the other hand, Optimus and the AI businesses, while still generating insignificant profits, could provide a new growth trajectory that increases Tesla's PE. So Gary is acknowledging that there is a lot of potential here. Number nine, to be conservative, we estimate 20% earnings per share growth from 2030 forward at a normal 1.5x mega cap growth peg. That suggests a Tesla 2030 PE of 30 or a 2030 Tesla value of 630. And Gary uses a discount rate of 13.6%. He assumes a 4% 10-year treasury rate, a 6% equity risk premium, and a 1.6 Tesla beta. So discounting back from $630 to today at 13.6%. For 6 years, you get $290 today. When we forecast slowing Tesla earnings growth based on an auto business, which has high transparency and is easy to model but is slowing down, both complain that we are not properly valuing their Robotaxi or Optimus businesses, which are ascending. Let's be real, there are no Robotaxi or Optimus businesses yet. They are concepts without total addressable markets, competitors, or tangible products, so can't be valued with the same level of conviction as EVs. Many denigrate us as baby boomers, but frankly, that has nothing to do with our approach, which is based on best financial principles and which we have applied consistently for years. It's about financial modeling and discipline and not letting concepts become more important than analysis, to which many investors pay little attention. Our Tesla valuation has nothing to do with our age. It's about best principles and discipline. I think if you want to be relatively conservative with your valuation, Gary's model is not a bad place to start. Here are how many Wall Street analysts have buy ratings. 21 say buy Tesla stock, 26 say hold, and only 12 say sell. So despite the sentiment supposedly being a lot more negative, more Wall Street analysts still say buy than sell. The average 12-month Tesla stock price target is $217 right now. Currently, Tesla stock is Gary Black's third largest position after Google and Nvidia. Gary says, in 4.5 years owning Tesla stock, I have never seen Tesla bulls attack each other as aggressively as they have on X of late. There's always been different degrees of Tesla bullishness, but this level of divide, seemingly sanctioned by Elon, is unprecedented in its ferocity, advising fellow bulls like myself to just sell their shares rather than object. The analogy would be telling your husband or wife to leave because she has the audacity to disagree with you. This intolerance of negative feedback will lead to an echo chamber if left unchecked. I think partially it's because some people are actually selling Tesla stock. For example, the Tesla economist just sold Tesla stock. So I think the reason why many people are saying things like sell your Tesla stock is because they actually think you are going to sell your Tesla stock. And also, if Gary Black sells all of his Tesla stock position, it won't be the first time. So that's another reason why people say to Gary Black, sell your Tesla stock if you want to. While there's a point to be made here, I don't think Gary Black is really fully right here. It won't go over well with big institutions if Elon's 2024 compensation plan reflects market cap tranches based off today's depressed Tesla stock price, which was largely self-inflicted. It's not lost on anyone that when Elon starts trash talking about Rivian potentially going bankrupt in 6 quarters despite $9.4 billion in cash and marketable securities versus just $1.25 billion in debt coming due in the next 4 years, and with Rivian guiding to positive gross margins by Q4, which reduces the cash burn by $2 billion a year, Tesla stock falls in sympathy. I think, yeah, ideally, you would want these compensation crunches to start maybe at about $2 trillion or something like that. But also, if you look at, for example, BYD, which kept growing volumes smoothly, relatively speaking, it's still down 47% from the peak. Some companies are down a lot more than that. Rivian is down 92%. From all-time highs, Tesla stock is down, but it's down roughly as much as BYD is. And BYD's CEO is not posting anything controversial on his Twitter account. So Tesla stock at $100, okay. Back in December of 2022, I could have seen that argument today with Tesla stock at 190. But then, of course, you can make an argument that looking at NASDAQ 100, which actually went up by a little bit since Tesla reached its peak, you can clearly make an argument that Tesla stock should not be down, and that's Elon's fault. The NASDAQ 100 technology sector had pretty much the same performance as NDX, by the way. However, even though I see Tesla as a technology company, most investors, especially the institutional investors, don't see Tesla like that. Even Gary Black doesn't see Tesla like that. So if you don't see Tesla as a tech company, I don't think you should compare the performance to tech companies. Because remember, I'm talking specifically about institutional investors here. Even GM stock is down not quite 50% from the same moment that Tesla reached its peak, but there's certainly some coincidence here. Maybe if Mary Barra stopped tweeting about politics, the stock would not have dropped as much. Coincidentally, Ford is down 50% from its previous high in 2022. You should have seen his controversial tweets. I mean, the Ford CEOs. So if you view Tesla as a technology company first, then you're not really upset with anything in a major way in terms of how decisions have been made because technology has been prioritized first. So FSD, Tesla bot, etc. If you see Tesla more as a car company, then today you're livid. Why did Elon prioritize FSD instead of the next generation vehicle? But then at the same time, if you see Tesla as a car company, why are you so upset that Tesla performed in line with how other car companies have performed? And if you see Tesla as a tech company, then I think it's fair to say that tech companies are really volatile. Often nothing happens until something really big happens. In other words, I don't really expect Tesla to perform exactly in line with other tech companies because some other company can do fairly well, while Tesla might be struggling, and then while other tech companies will be struggling and not doing much, Tesla will explode. Anyway, the way I see Tesla is I see it as a tech company that happens to be in the car business at the moment. And with time, that will become very apparent. Gary Black says investors keep asking why Wall Street doesn't put much value in Tesla's AI, so Robotaxi, FSD, licensing, Optimus, and Dojo. The short answer is Tesla doesn't disclose results for its AI businesses, unlike NVIDIA, which is 100% specialty chips, including AI chips. How can one expect institutional investors to put a value on something that the company doesn't disclose on a regular basis and which remains invisible? How can you expect institutional investors to do some serious research and some serious thinking about the long-term prospects of the business? You would be making up numbers that one cannot verify, which is what investing largely is. You research and then you come to your own conclusions, and then time eventually verifies your thesis. Sure, we can say FSD is going to be huge and wow, look at the progress Optimus is making, but it's not disciplined to put a made-up multiple on huge or wow. This is very different from 2017 and 2018 when I first got involved in valuing Tesla, where one could size the auto market, forecast EV adoption, forecast Tesla's share of EVs, assume an average selling price and gross margin, tax effect, and come up with an earnings or EBITDA forecast 5 years out, discount it back, and put a value on it. Because if you look at the world economy, clearly labor is not as big as the auto market, right? Especially if you combine the transportation market with the labor market. These two things combined are clearly smaller than the auto market, right? So that's why there's no way, for sure 100%, that the Tesla bot and FSD would ever have huge impact on Tesla's valuation because no one has ever done it before. I appreciate Gary's take, and this gives us great insight into how institutional investors think, which reveals some very conservative thinking, and some might even say sloppy and lazy thinking. Have you ever heard the expression of someone working so hard every single day, 12 hours a day, that actually they are so lazy to just stop and think for a little bit so that they can cut their work in half? I think when it comes to investors, sometimes investors just get stuck in their old ways, and if you manage a lot of money, you want to be conservative, and I understand that. But that means you will for sure guaranteed will miss out on some huge opportunities in the future. I feel sorry for those people that invested in Rivian that looked at this stock and thought, oh, next Tesla, yay! No thinking. Next Tesla, yay! Or Lucid stock, yay! Next Tesla. They even have a former Tesla employee leading Lucid, which explains why it's down 69% since its IPO. The thing is, if Tesla in the beginning had to compete with a somewhat strong Tesla, then today's story would be very different. But that's what all of these other EV startups have to do. They have to compete with Tesla. So just thinking for a little bit and just understanding that, I think, would have saved a lot of people a lot of money. There's a Tesla bot job offering in Vancouver. That's interesting. Maybe I'll let some of my friends know that they might be able to get a job with Tesla. I saw someone say that this is probably due to these tax incentives that Canada offers. Like and subscribe if you haven't yet, and remember that thinking hurts. Yes, it does, but losing money, oh, that just hurts a lot more. So think, and think carefully before putting any money into any one of these EV stocks that are not Tesla stocks, because they have to compete against Tesla, and Tesla does not have to compete with another Tesla.